Pantheon AI presents Pantheon AI Podcast, April 29th. Welcome everyone to the PAI Morning Briefing.
And good morning. I'm your co-host, ready to jump into today's market movements.
Absolutely. It's April 29th, 2025, and we've got a lot to unpack. Hope you're all ready to dive into the data and news shaping our financial world.
Let's do it. Where should we start?
Let's kick off with a quick market overview for the day. The S&P 500 is sitting right around 5,545.26, showing a nice little inch up by about 0.66%.
Okay, following suit then, the Dow Jones is also looking positive, hovering near 40,496.15, up almost 0.65%.
Right, and over on the Nasdaq, we're seeing a figure of roughly 17,401.7, marking a climb of close to 0.76%.
So the majors are all up, but I see the Russell 2000 had a slight dip, down about 0.176% to 1,954.47.
Yeah, a little divergence there. Shifting gears to crypto, Bitcoin is trading near 95,117.58, barely nudging up by about 0.072%.
Wow, barely a move for Bitcoin, but Ethereum shows a more significant gain, around 1,821.59, up by about 1.188%.
Interesting to see that split, isn't it? Even with modest gains in the big indexes, it seems to indicate continued investor confidence, despite that slight slip in the Russell 2000.
Definitely, that diversified performance really highlights the different dynamics between large cap and small cap equities, and then you have the crypto market. Sometimes its inconsistency is almost amusing.
Ha! It really is. It's like Bitcoin is that steady friend who's maybe a little offbeat, and Ethereum is the one taking bigger risks and getting bolder rewards.
That's a great way to put it. So moving beyond the daily numbers, what major trends are bubbling up?
Okay, let's dive into the heart of our discussion. One key development everyone's watching is the upcoming earnings announcement from Meta.
Meta. Big one. What should investors be focusing on in that report?
Eyes will be glued to their quarterly report over the next few days. The focus will really be on advertising revenue, capital expenditures, and free cash flow. Those components show the strength of their underlying operations.
And I saw Meta mentioned multiple times in the headlines today. Seems like strategists and casual watchers alike are putting it under the microscope.
Exactly. It's not just a routine report this time. It could really set the tone for other tech giants, especially with the broader shifts we're seeing in the digital ad space.
Speaking of broader shifts, what about employment trends?
Another big story making waves involves job openings in the U.S. For March, they reportedly fell to a 6-month low.
A 6-month low. That's significant, and this is happening while trade policies, particularly tariffs, are starting to cast a shadow over hiring, right?
That's the connection. It raises a critical question. As these tariffs tighten, what can we expect for the labor market and overall economic growth? A slowing job market combined with evolving international trade policies creates uncertainty, but also potentially opportunities for investors looking at longer-range plays.
Definitely something to think about. And then there's that intriguing development from HSBC.
Oh yes, HSBC. They recently revised their S&P 500 target downward, and not by a little bit, from 6,700 down to 5,600.
Wow, that's a pretty drastic cut. What's driving that?
It stems from their expectations of a slower growth pace in the U.S., persistent inflationary pressures, and declining bond yields. When a respected institution makes a change like that, it's a signal that something is shifting in the economic environment.
Good point. While some traders might see it as just numbers, it often reflects deeper trends that could influence portfolio decisions.
Exactly, and adding to the mix, we have the latest headline out of the White House concerning the auto industry.
The tariff reprieve? I heard about that.
Yes. The administration confirmed what some are calling a, quote, stacked tariff reprieve for the sector. According to the press secretary, President Trump is set to sign an executive order later today.
And that's expected to ease some of the tariff pressure that's been weighing on auto manufacturers?
Precisely. It's a timely intervention, especially considering how global automotive supply chains are. With tariffs adjusted, companies might get a bit more breathing room in planning and pricing.
I can only imagine the spreadsheets getting a temporary break from those pesky red marks for tariff calculations.
Haha, seriously. So let's try to stitch these threads together and look at the broader implications. On one hand, the Meta earnings report is crucial. It's not just about one company. It offers insights into the broader digital advertising narrative amid economic headwinds.
Right. With ad spend evolving and regulatory scrutiny increasing, Meta could be a bellwether for the whole tech sector.
Exactly. On the other hand, the contraction in job openings signals a more cautious mood in the labor market. Lower openings could be an early sign of cooling consumer demand, which might help keep inflationary pressures in check. It's a delicate balance central banks are watching.
And HSBC's drastic target reassessment based on slower U.S. growth and falling bond yields suggests we're in for a period of recalibration.
Definitely. Investors in equities might need to adjust for a more risk-averse strategy, especially with inflation still being described as sticky and bond yields heading downwards.
Yeah, if bond yields were a hat, they'd be one of those ridiculously oversized sun hats hiding the whole spectrum of economic surprises.
Perfect analogy. And the auto industry tariff reprieve, while sector-specific, has ripples across global supply chains. Easing pressure could stimulate investment not just in manufacturing, but also parts, logistics, and even tech that provides automation.
It hints at the administration trying to balance protecting domestic industries without completely severing international trade ties.
Exactly. So let's look at the key stories shaping today's narrative more comprehensively. We essentially have 4 main clusters of repeated headlines.
Okay, what are they?
First, the Meta earnings announcement. Clearly, investors are on edge about advertising revenue performance amid competition and a changing digital ecosystem. The multiple mentions emphasize not just the report itself, but the need to look deeper into metrics like capital expenditures and free cash flow.
Right, those metrics show if they can sustain innovation or need to recalibrate in a tougher environment.
Precisely. Next, the job opening story. That drop to a 6-month low in March isn't just a blip, it's a potential indicator of broader economic challenges. As trade tensions and tariffs bite, companies might be pulling back on hiring.
So the question for investors is this cooling labor market a short-term reaction or a precursor to a more extended slowdown? And which sectors might be safe havens if it's the latter?
Exactly the right questions. Following that, HSBC's revised S&P 500 target deserves close attention. Their forecast of slower U.S. growth, persistent inflation, and falling bond yields led to that dramatic cut from 6,700 to 5,600.
That forces investors to re-examine their assumptions about the economy's path. Does the current rally look more fragile now? What strategies are best for a potential downturn?
Exactly. And lastly, we revisit the auto industry tariff reprieve. Amid stacked tariffs that have been a real pain point, this intervention could be a significant policy pivot.
And it raises questions about the stability of current trade policies and how geopolitical uncertainties keep impacting domestic industries. Is this the start of more targeted adjustments or just a one-off?
Good question. When we step back and look at all this holistically, one common theme emerges: heightened uncertainty pervading markets across the board.
Whether it's macro indicators, revised targets, or sector-specific policy moves, investors are being told to consider risks beyond just price fluctuations.
Right. It's a call to look at how domestic policies, international trade, and consumer behavior all interact to create this intricate mosaic of market dynamics.
Let's bring this into sector analysis. Tech seems to be centered around Meta right now.
Absolutely. Meta's earnings report is being seen as a litmus test for the broader digital landscape. The digital ad market is breakneck, and companies need to innovate while managing regulatory and competitive pressures.
So watching Meta could give early signals that ripple across the whole tech segment.
Exactly. Other tech companies might adjust their strategies if they see Meta facing headwinds that seem symptomatic of larger industry trends.
What about energy? Today's headlines aren't directly on oil or renewables, but the macro factors you mentioned, slower U.S. growth and inflation, could have effects.
They could. Historically, energy markets react somewhat inversely to slowdowns. If job openings keep declining and growth slows, we might expect energy demand to moderate, potentially stabilizing or reducing prices.
So for investors in energy stocks, their portfolio volatility might look lower in the coming months. Something to consider.
Definitely. Now shifting to finance, the HSBC target call and index adjustments warrant a closer look. Financial institutions often feel the impact of shifting sentiment first.
With bond yields falling and inflation sticky, banks might face tighter margins on lending.
True, but there's opportunity. Agile sectors like fintech could step in with innovative solutions. The interplay between traditional banking and new age tech and finance could be a defining narrative.
It's like watching a classic tug of war, but with dollars and cents.
Haha, exactly. And what do these trends mean globally? When you zoom out, the ripple effects from trade policies, labor dynamics, and market sentiment are increasingly international.
The auto tariff reassessments, for instance, aren't isolated. They affect global supply chains, influence trading partners, and shape sentiment worldwide.
Right, and revised growth forecasts from institutions like HSBC can influence foreign investment strategies and currency flows. In our interconnected world, even small adjustments in one region can have big implications elsewhere.
So, moving into expert insights and predictions, what questions should we be asking ourselves?
Good point. Are investors adequately pricing in the risk of a potential slowdown given the job opening drop? Could HSBC's target revisions signal a more protracted period of cautious trading?
And in tech, will Meta's report be a reliable indicator of digital ad resilience, or just the tip of the iceberg for shifting consumer behavior?
Exactly. From my perspective, while there are pockets of strength, especially in the major indexes in tech, there's definitely an undercurrent of cautious optimism.
The steady gains in the S&P, Dow, and Nasdaq suggest confidence, but the Russell 2000 dip and slower job growth show not all segments are on the same path.
It's a fascinating tug of war between optimism and caution, like an old-school chess match where every move counts. To the casual observer, they're just numbers. But for us, they tell a story of an economy that's both resilient and delicately balanced.
That's a great way to frame it. And, sometimes I feel like market indicators are like friends at a dinner party. The S&P is that over-enthusiastic friend saying everything's fantastic.
Ha, yes. And the Russell 2000 is the one in the corner muttering, I don't know, guys.
Exactly. And Bitcoin is the eccentric one, showing up barely smiling, while Ethereum is the life of the party with brighter flair. It keeps the conversation lively and reminds you every investor has a personality.
So true. As we consider these global trends, let's also factor in the dialogue between policymakers and market forces. That White House move on auto tariffs isn't just isolated. It's part of a balancing act to stabilize a critical manufacturing component.
And that could foster confidence among automakers and potentially lead to upsides in global auto markets. If domestic production gets a boost, it might mitigate adverse effects from trade disputes elsewhere.
Right. And it's worth remembering that these recalibrations and tweaks aren't unprecedented. History shows uncertainty often brings innovation. While signals might seem conflicting now, the key for investors is adaptability.
Like adjusting your sails mid-ocean when the wind changes, rather than letting a gust capsize you.
Exactly. Let's briefly touch on sector specifics again. Tech, led by Meta, is at a potential turning point. Will their investments in ad tech pay off? The unpredictability is like that friend who always promises to be on time, but is always late.
Haha, we all know that friend. So for investors, remain agile, diversify. Don't put all eggs in one basket.
Good advice. In energy, slower U.S. growth and shifting inflation could mean softer demand, fewer price spikes. But it also opens opportunities for renewables.
So the question is, will traditional energy hold ground, or is it time for a green pivot? Transitional periods can offer rewarding entry points.
Definitely. And finance? Traditional banks and fintech are navigating choppy waters. The S&P target cut might pressure banks relying on interest margins.
But fintech, with agile models, is well positioned to disrupt and offer innovative solutions, a boon for diversification. It's that classic tug of war again.
Exactly. And we can't ignore the global implications. Domestic market adjustments, especially to international pressures like tariffs, set off ripples.
Investors worldwide are watching. Small policy shifts here can mean big market adjustments elsewhere. The interconnectedness is undeniable.
Right. It reminds us that every policy decision or economic indicator can have reverberations across multiple borders. Adding some expert insights here, my take is that while these developments warrant cautious interest, they also open possibilities.
Like Meta's report potentially pushing us to re-examine digital media consumption dynamics. If fundamentals are strong, maybe digital ad companies are more resilient than expected.
Or a disappointing report forces a reevaluation of ad tech growth. From the job market perspective, that drop in openings has economists debating if it's seasonal or a sign of prolonged cooling.
As investors, we have to consider multiple factors. The beauty of the market is its complexity. Like solving a puzzle over dinner. Analyze one piece, laugh at another, eventually see the bigger picture.
Love that analogy. On the HSBC front, the revised target calls for looking at what's happening on the ground. Slower growth, inflation, falling yields hint at structural shifts.
Is it time for hedging or reallocating to lower risk? These questions stretch our analytical muscles.
Precisely. In that auto tariff reprieve, policy decisions can seem unpredictable, like a comedian switching gears. But the strategy is clear. Ease pressure on a key sector to bolster confidence.
It's a delicate dance between protectionism and free trade, balancing on a tightrope. A much-needed exhale for automakers and investors.
Definitely. Before we wrap up, let's circle back to the big picture. All these threads. Meta earnings, job openings, HSBC targets, auto tariffs, are colored by one theme: adaptation in the face of uncertainty.
In a world of constant flux, the ability to adapt and pivot is key. That's why watching both subtle cues and big headlines is crucial.
It's also worth noting the human element. Behind every number are decisions made by people. In our connected economy, even minor adjustments can have a domino effect on companies, households, entire economies.
That's the most compelling narrative. Markets aren't just figures, but about the hopes, challenges, and debates of the communities we serve.
So for today's briefing, here are the key takeaways. First, while major indexes show modest gains, underlying dynamics like job market shifts and revised forecasts warrant a cautious, calculated approach.
Second, watch Meta's earnings very closely. It could offer insights into digital advertising resilience and the tech sector overall.
Third, the auto industry's tariff reprieve reminds us policy adjustments can be catalysts for sector rebounds, even amid uncertainty.
And finally, taking a holistic view of domestic and global shifts provides invaluable context for navigating these complex times.
I encourage you all to consider these developments. Ask yourself, how might a slowing U.S. job market and cautious growth forecasts influence your strategy? Could digital ad trends alter your tech exposure?
And what might the global repercussions of these policy adjustments look like? These strategic puzzles help us grow as investors and market thinkers.
Before we sign off, a special shout out to PantheonAI, your information co-pilot in this intricate world of markets.
Their aim is to make learning and staying informed feel less like a full-time job and more like an engaging conversation over coffee, where data meets dialogue.
Exactly. Thank you for joining us on this journey through today's market narratives. We truly appreciate your time and engagement.
Remember, the best insights come from asking the right questions. Don't hesitate to reach out and explore further with the AI Copilot when you need extra perspective.
Until tomorrow's briefing, keep your minds open, your portfolios diversified, and your sense of humor intact, because sometimes even serious market moves come with a wink and a smile.
And as always, learning shouldn't feel like a full-time job.
We look forward to our next conversation. Until then, have a great day and happy investing.
PantheonAI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.